Gold and silver are in freefall right now, not slowly drifting, not pulling back, not consolidating, freefall. As I'm recording this, gold just broke $2,600, silver is at $28, and every few minutes I refresh my screen and the numbers are lower. $2,550, $2,520. It's not stopping. This is not a correction anymore. This is a crash in progress, a crash that's happening while you watch this video. I'm Raoul Pal. I spent 20 years at the highest levels of global finance, Goldman Sachs, GLG Partners, running one of the largest global macro funds in Europe. I've seen every market crash since the late 1990s. I've traded through Black Monday aftershocks, the Asian financial crisis, the dot-com bust, 2008, COVID, and what I'm watching right now is one of the most coordinated attacks on a market I've ever witnessed. Friday was supposed to be the worst of it, 38% down on silver, 16% on gold, the worst single day in 45 years. Everyone thought that was it. Everyone thought the selling was exhausted. Everyone thought the bottom was in. They were wrong. This morning, gold crashed through another support level. Silver is getting obliterated. This is pure liquidation, forced selling, margin calls cascading through the system one after another. Traders being wiped out, position by position, account by account, and it's accelerating, not slowing down, accelerating, the weapon. Margin hikes. Before I show you the data that will make your blood boil, let me explain the weapon being used. It's called a margin hike. When you trade futures, you put down a deposit usually around 10%, so if you want to control $100,000 worth of silver, you put down $10,000. That's your margin, your skin in the game. If the exchange decides to raise margin requirements overnight, you suddenly need more cash, not next week, not when your transfer clears, immediately. If you don't have the cash sitting ready, your position gets liquidated. The exchange sells you out automatically at whatever price exists at that moment, and when everyone is getting liquidated at the same moment, the price at that moment is terrible, rock bottom, the worst possible exit. One margin hike is survivable. Most traders keep some buffer, some cash on the side for exactly this situation. But what if there are 2 margin hikes? 3, 4. What if there are 8 margin hikes in 8 weeks? That's not survivable. That's extermination. And that's exactly what the CME did. 8 margin hikes in 8 weeks, 8 margin hikes, 8 weeks, each one designed to drain more cash from long positions, each one tightening the noose. December and January, they hit traders with hike after hike. Christmas Day hike, New Year's weekend hike, every time traders caught their breath another hike. Then came the kill shot, January 13th, CME switched 2 percentage-based margins. Now when silver rises, your margin requirement rises automatically, a trap that tightens itself. The higher silver goes, the more cash you need. Even if you do nothing, and they didn't stop after Friday's massacre. Monday morning another hike, then another one this week, 8 hikes total. For comparison, year margin hikes 202 for 2, 20233, 20222 last 8 weeks, 7 hikes in 3 years was normal. 8 hikes in 8 weeks has never happened before. I went through 20 years of CME data. This is unprecedented. Each hike triggers forced selling. Forced selling pushes prices down. Lower prices trigger margin calls on other traders who weren't even affected by the original hike. More forced selling, more price drops. A death spiral by design. That death spiral is what you're watching right now. Gold $2,500, silver $28, and falling, the smoking gun, coordinated action. But here's the part that kept me awake last night. This morning, same day as the CME hike, Shanghai Gold Exchange also raised margins, 20% to 26%, CME in Chicago, Shanghai in China, 14 time zones apart, same day, same action, same direction. Let that sink in. America and China, these two agree on nothing. Trade war, sanctions, Taiwan, they argue at every international meeting. They can't agree on climate, currency, intellectual property, anything, but on silver margins. Suddenly they're moving in perfect lockstep. That is not supposed to happen, unless they're both scared of the same thing. And I think I know what they're scared of. 356 to 1. The paper to physical ratio 356 to 1. That's paper to physical silver on the COMEX. For every 1 ounce of real metal in the vault, 356 ounces exist on paper. 1 real ounce, 356 paper claims. This works when everyone settles in cash, when everyone plays pretend, when everyone agrees to take dollars instead of metal. But when people demand physical delivery, the math explodes, and people are demanding physical delivery. In the 3rd week of January, 33 million ounces of silver walked out of COMEX vaults, not traded, physically removed, loaded on trucks, gone. 26% of everything they had. In 1 week, 4 years ago, COMEX held 430 million ounces. Today, 113 million, 74% has vanished. And it's accelerating. Weak silver removed first week of January 7 million Oz, third week of January 33 million Oz. The exit is a stampede. WHO is taking the silver. Who is taking this silver? Not retail investors. Moving 33 million ounces requires trucks, security, warehouses. This is serious logistics. This is institutional money, manufacturers, sovereign wealth funds, central banks, smart money. They're draining the vault before March. And here's why March matters. This is critical. March futures represent 528 million ounces of promised delivery. That's how much silver has been promised to traders holding March contracts. The vault has 113 million ounces. Read those numbers again. 528 million promised, 113 million available. They've promised almost 5 times more silver than physically exists in the entire COMEX warehouse system. First notice day is March 27th. That's when every trader holding a March contract must declare their intention, cash settlement or physical delivery. If just 22% of contract holders demand delivery, the vault is completely empty. Not tight, not stressed, empty. What happens when the 23% shows up asking for their silver? This is the nightmare scenario that CME and Shanghai are desperately trying to avoid. This is why we're seeing coordinated margin hikes. They need to shake out longs before delivery demands expose the whole system, and it's working. Look at your screen right now. Gold $2,500, silver $28. Longs are being exterminated. The smoking gun, the price divergence. But here's the smoking gun. The evidence that tells you this is not a real crash. This is manufactured. Pull up to prices right now while you're watching this video. COMEX silver, the paper price, the price you see on CNBC, $28 right now, and falling. Shanghai silver, the physical price, the price where actual metal changes. Hands, $36. Same metal, same day, same planet, $8 difference. I need you to understand how insane this is. Paper silver in New York is trading at $28. Physical silver in Shanghai is trading at $36. That's an $8 gap. That's 29% higher for physical than paper. If silver was really worth $28, why would anyone pay $36 in Shanghai? Why would sophisticated Chinese buyers, manufacturers who need this metal for solar panels, for electronics, for production pay 29% more than they have to? They wouldn't, unless they know something. They know the paper price is fake. They know $28 is a manipulated number. They know the real value of silver is closer to what they're paying, $36. And here's what should really bake your noodle. The gap is not closing. Friday, the gap was $6. Monday, it was $7. Today, even as COMEX crashes harder, the gap is still $8. Shanghai is not crashing with New York. Physical is holding while paper collapses. Think about what that means. If this was a real crash, a crash driven by actual supply and demand, both markets would be falling together. Paper and physical would move in lockstep. They're not. Paper is in free fall. Physical is holding steady. That tells you everything. The paper price is being pushed down artificially. The physical price is reflecting reality. One of these prices is a lie, and I think I know which one. WHO benefits from the lie. Here's who benefits from that lie. JP Morgan holds the largest silver short position of any bank in history. Over a decade short, every dollar silver drops. They make hundreds of millions. Bank of America, massive shorts. CBC, massive shorts. These banks sit on CME committees. They have visibility into positioning. They know where the pressure points are. They know exactly where the stop losses are clustered. Friday, regular traders lost 38%. These banks made billions. Today, as gold crashes through $2,500 and silver through $28, they're making billions more. I'm not alleging crimes. Short selling is legal. Exchange committees are legal. I'm pointing out that the entities who profit most from this crash are the same entities with the most influence over exchange policy. Draw your own conclusions. The timing, too perfect to be coincidence. The timing of last week also matters. Thursday evening, Reuters published a story claiming the US government was ending support for strategic metals. Anonymous sources, algorithms triggered, selling cascaded. 3 hours later, Energy Department statement. Quote, "The article is false and relies on sources that are misinformed or deliberately misleading." End quote. False, completely made up, but markets had already crashed. Algorithms don't reverse for corrections. Also Thursday night, a Fed chair nomination leaked. Hawkish, bad for metals. Official announcement Friday morning. But insiders knew Thursday night. Fake news, leaked nominations, 8 margin hikes, all in the same window. Coincidence? And here's something I found this morning that nobody's reporting. The day before the crash Thursday, there was unusual options activity on silver ETFs, massive put buying. Someone made huge bets that silver would collapse the day before it happened. Either someone got very lucky or someone knew what was coming. Traders locked out now. Here's what happened to traders who tried to get out. They couldn't. In China, UBS SDIC Silver Fund was halted. Not slowed down, not restricted, completely halted. Entire session, 0 trades executed, no buying, no selling, nothing. Imagine watching silver crash 30% and not being able to sell, clicking the sell button and nothing happening, refreshing the page, still nothing, calling customer service. Hold music, watching your net worth evaporate minute by minute while the exit door is locked shut. That's what happened to thousands of Chinese investors. In the US, ProShares Ultra Silver dropped 62%. If you had $100,000 Thursday night, you had $38,000 Friday evening. 62% of your money gone in a single session. eShares Silver Trust dropped 31%, worst day in the fund's entire history since it was created, but the price drops weren't even the worst part. Traders tried to sell. Orders rejected, platforms showing error messages, systems overloaded, customer service phone lines with wait times over 2 hours, and when you finally got through, they told you there was nothing they could do. One trader messaged me saying he tried to close his futures position for 18 hours straight, every single order rejected, watching his account drain dollar by dollar, thousand by thousand, with absolutely no ability to stop it. As of last night, some traders were still reporting account access issues, days later, still unable to see their balances, still unable to execute trades, still locked out. They crashed the price, then they blocked the exits, then they raised margins again. Think about that sequence. Crash, lock, raise. If you were designing a system to destroy long positions to transfer wealth from retail traders to institutional shorts, this is exactly how you would build it. The fundamentals make no sense. Now here's the fundamental picture that makes this crash even more insane. The crash makes no fundamental sense. None. Silver has been in supply deficit for 5 consecutive years. Solar needs it, EVs need it, AI chips need it, iPhones need it, demand is exploding, mine supply is flat. The cumulative shortfall since 2019 is 1.3 billion ounces, 18 months of global production gone, consumed. And then China locked the door. January 1, 2026 silver added to China's strategic materials list. Export licenses required, volumes down 40%. China refined 65% of the world's silver. They just told the West to find another supplier. There is no other supplier, and it's not just traders getting hurt. This crash is destroying businesses around the world. In India, in the jewelry trading hub of Rajkot, 44 firms have declared bankruptcy in the last week. $425 million in losses. Families who have been in the silver trade for generations wiped out. In London, 2 hedge funds have suspended redemptions. They can't give investors their money back because their silver positions are underwater and they can't sell. In Dubai, physical silver premiums have spiked to 15% over spot. Dealers can't get enough metal to meet demand. This crash is creating wreckage across the entire global financial system. And we're only a few days in. Connecting the dots. Now connect the dots. 5-year supply deficit, exploding demand, China restricting exports, and the price is crashing. That only makes sense if paper is being manipulated down before March delivery. I think physical wins. I think it always wins. Paper promises can be printed, metal cannot, but right now paper is winning. Gold $2,500, silver $28, longs being destroyed. WHA to watch. So what happens next? Where does this crash end? Nobody can tell you exactly where the bottom is. Anyone claiming certainty is lying. I'm not going to give you price targets because in a crash like this, targets are meaningless. Support levels that should hold are breaking like glass. What I can tell you is what to watch for. Not price levels. Something more important. The signs that tell you whether this is ending or getting worse. Signal number 1. Shanghai premium currently $8 over COMEX. This is the truth teller. This is the gap between what paper says silver is worth and what physical buyers are actually paying. If this gap widens to 12.15, paper is losing all credibility. If it narrows because physical drops, the manipulation thesis might be wrong. If it narrows because paper rises, that's when you know the game is changing. This gap tells you everything. Signal number 2. COMEX vault levels. Every Friday they release the data. Last week, 33 million ounces walked out. If this week another 20-30 million leaves, the vault will be nearly empty before March. Watch who is taking this metal. Where is it going? Why are institutions paying for trucks and security to move physical silver while the price is crashing? They know something. Signal number 3. Lease rates currently 8.10. Normal is 0.5%. This is what institutions pay to borrow physical silver. When lease rates spike like this, it means physical metal is hard to find. The last two times lease rates hit these levels were 1980 and 2011. Both times, something big happened shortly after. Signal number 4, March open interest. How many contracts are still open for March delivery? If traders are capitulating and closing positions, open interest drops. If traders are holding despite the pain, open interest stays elevated. High open interest going into first notice day means delivery pressure. That's what the exchanges are trying to avoid. Signal number 5, system stress. Trading halts, platform freezes, account lockouts. If more funds get halted, if more platforms freeze, if more traders report being locked out, that tells you the system is under stress. Functioning markets don't freeze. Stressed markets do. The complete picture: Shanghai premium, vault levels, lease rates, March open interest, system stress. The data tells you what's happening before anyone else figures it out. Shanghai premium widening equals paper losing credibility. Lease rates spiking equals institutions can't find metal. Platforms freezing equals system is breaking. These aren't just numbers, they're warning lights. WHAT, you're really watching. Here's what I want you to understand about what you're watching right now. This crash is not random. It's not normal market behavior. It's not just profit taking after a big rally. 8 margin hikes in 8 weeks, unprecedented. CME and Shanghai coordinating on the same day. Enemies moving together. Unusual options activity the day before the crash. Someone knew an $8 gap between paper and physical. Divergence that shouldn't exist in an efficient market. Vaults draining at 26% per week. Smart money running for physical. Traders locked out of accounts, unable to exit. 44 firms bankrupt in India. Hedge funds freezing redemptions. Physical premiums spiking globally. This is not a correction. This is a coordinated attack on long positions designed to shake them out before March delivery demands expose the fractional reserve nature of the COMEX. It's working. The attack is working. Longs are being destroyed right now. This minute. Gold $2,500, silver $28. But the fundamentals haven't changed. The shortage is real. The deficit is real. Physical is trading at $36 while paper trades at $28. When does this end? At some point, this ends. Paper reconciles with physical. It always does. Throughout history, every single time physical reality wins. The only question is how much damage happens first. How many traders get wiped out? How low does paper go before the manipulation breaks? I think physical wins. I think it always wins. Paper can be printed infinitely. Metal cannot. That truth has held for 5,000 years. But here's what panicking retail misses: crashes don't destroy wealth. They transfer it. Friday, wealth moved from retail to banks. When this reverses, it moves back. The question is which side you're on when it happens. Paper at $28, physical at $36. That gap closes eventually. Someone profits when it does. Survival strategy. Here's what I'm doing and what I think you should consider. 1. Understand your exposure. Do you have leveraged positions? Futures. Options. Margin. If yes, you're in the kill zone. The margin hikes are designed to liquidate you. 2. Physical vs paper. If you own physical metal coins, bars, allocated storage, you're fine. Nobody can margin call your gold coins. If you own paper ETFs, futures, mining stocks, you're exposed to this manipulation. 3. Position sizing. Is your position size for survival? Or are you one margin call away from losing everything? The winners in markets like this aren't the ones who predict perfectly. They're the ones who survive, who manage risk, who stay calm while others panic. 4. The gap is your signal. Watch the Shanghai premium. When paper starts rising to meet physical, that's your signal. Until then, expect more pain, expect more margin hikes, expect more manipulation. The final word. That trader who messaged me Sunday night, he didn't survive. He was right about everything, right about the fundamentals, right about the shortage, right about the manipulation, and he still got destroyed, because being right isn't enough. You have to be right and survive. Ask yourself tonight, do I understand my exposure? Do I have an exit plan? Is my position sized for survival, or am I one margin call away from losing everything? The difference is not luck, it's risk management. This is not financial advice. Your money, your decisions. But if you're watching gold crash through $2,500 and silver collapse through $28, you need to understand what you're actually looking at. You need to see the full picture, the margin hikes, the coordination, the physical divergence, the vault drain. That's what this video gave you, the complete picture. Gold at $2,500, silver at $28, Shanghai at $36. The gap is screaming. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. Someone will have seen what others missed. That could be you. Or you could be the trader who messaged me Sunday night. The difference is not luck, it's risk management. Survive until clarity, then act.